So, what is the current situation? Brexit is a variation of British exit, which means the UK withdrawal from the EU. Brexit remains a controversial topic for quite a long time in the UK, since 1973. In June 2016, the people of Britain voted for Brexit in the historic referendum, with a result of about 52% of living votes. The full process of withdrawal may take up to about 10 years. And now, what had happened after the referendum? The vote to leave, also called Brexit, raised the prospect of sustained uncertainty in the global economy as investors struggle to surmise what is happening. The pound plummeted, reaching the depths not seen in 1985, well below the value at the worst of the 2008 financial crisis. The euro also rocked. From Tokyo to London and to New York, stocks stumbled sharply on Friday as markets digested the changing world order. American shares were down 3.6%. British stocks were off 3.2%, while broader European shares dropped 8.6%.
The effects on Britain itself. Being in the European Union has a strong positive effect on trade, and as a result, the UK's trade could be worse off if it left the European Union. Brexit could lead to a reduction in investment from the rest of the European Union, which is the biggest source of FDI in the UK. The UK may seek to compete more aggressively for investment by undercutting the European Union on taxation and the business environment or increases in government spending. Beyond short-lived market volatility, the long-term economic prospects of Britain remain high, notably in terms of country attractiveness and foreign direct investment. Less regulation and more control over Britain's policy could outweigh the short-term uncertainty. However, existing EU regulations could make it harder for London to serve European markets, particularly for retail products and euro trading. The UK may also suffer an opportunity cost from being absent from future liberal initiatives such as Capital Markets Union, which could open up new markets in more secure areas. The City of London is currently world-leading in financial services, especially in currency transactions. However, there is a risk that some business, particularly banks locating in London, may lift altogether. The Treasury may also lose 5 to 10 billion pounds annually in tax revenue in the event of Brexit. The effect on the EU. The EU is a more important trade partner for the UK than the UK is for the EU. Its GDP would be around 50% lower without the UK. The EU would lose a significant net contributor to its budget. There could likely be a shift towards support for higher spending in the European Council. The European Central Bank could be compelled to raise its level of intervention. Brexit could create an extended period of uncertainty that damages confidence for investment in the rest of the EU. Alternatively, the EU could free itself of its most awkward member, making the EU easier to lead and more effective. The effects on the world. As investors pull back in fears, this British EU divorce will push capital away from the region and toward key safe haven markets, including the US and Japan. This will further lower market interest rates and raise the currency values. A higher US dollar and Japanese yen are negative to both economies' export sectors. The higher US dollar also forced China to float its currency less. Meanwhile, emerging markets may find it difficult to secure investment, limiting economic growth. Borrowing costs are likely to rise in heavily indebted nations, including Greece, Italy, and Portugal, as investors demand extra inducement to put their money in riskier locales. If no deal is struck, the rules of the World Trade Organization could apply. They give member nations the right to impose potentially steep tariffs on imports